Ladies and gentlemen, good day and welcome to Orient Limited Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Samant from Stellar IR Advisors. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us today. We have with us today the senior management of Orient Limited, Mr. Aditya Gupta, Chief Executive Officer, who will represent Orient Limited on the call. The management will be sharing the operating and financial highlights for the quarter ended June 30, 2025, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon the company's beliefs, opinions, and expectations as of today. These statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Aditya Gupta. Thank you, and over to you, sir.
Thank you, Suresh. Good evening and welcome everybody for our Q1 FY26 earnings call. As we saw in the last year, demand continued to remain subdued in this quarter as well. Heightened competition has forced a renewed focus on cost saving. There was some reduction of freights internationally, resulting in better exports during May and June. However, the 3-month moving average of exports is still below FY25. Government projects, execution, gas costs, geopolitical environment, and tariff war continue as decisive factors impacting demand across the building and construction industry. At OBL, we have continued focus on process and our mission to make tile buying easier for the end consumer. Multiple initiatives have been successfully launched for enriching the customer's buying experience. Some of these are launch of an AI-based visualization tool to aid our dealers convert walk-ins. This tool has already crossed 1 million plus views on Insta and double usage in the activated shops. Restructured OVTB, which is the Orient Tile Boutiques operations under 2 national heads, with an objective to drive display upgradation and influencer services to our 385 tile boutiques. A flatter sales structure with greater empowerment on ground. And of course, new products from our own units and training partners. All these have helped us almost maintain Q1 on volume versus last year. However, trade discounting has increased, leading to a lower ASP. OBL has registered a net sales of 142.5 crores compared to 147.3 crores in Q1, a drop of 3%. Our gross margins for Q1 FY26 have further improved by 50 basis points and now stand at 36.5%. Tight control on working capital has also helped improve our cash conversion cycle to 33 days versus 35 days in Q1 of last year. Consolidated EBITDA for Q1 FY26 stands at 5.6 crores and EBITDA margins have improved by 60 basis points over last year. Net debt position also stayed constant at a comfortable 9.5 crores with healthy cash balances. We have stayed on course towards investing in brand building and continued our TV campaign covering core markets of North, East and Tamil Nadu. This is helping us grow our brand awareness scores. The focus on customer experience and brand building continues to help drive vitrified mix, which also gained by 2% over last year to reach 58% of our sales. While salience of GVT increased by 1.6% over last year and now stands at 40.1%. This is now similar to our industry peers. To summarize, OBL has improved on cost, quality, brand awareness, financial health, working capital and gross margin. while maintaining volumes and investing for the expected upturn in industry. With this, I would like to open the floor to question and answers. Thank you.
Thank you very much. We will now begin the question.
Pooja, just one more thing. I just wanted to add something, please.
Yes, sir.
We also pleased to welcome Mr. Anuj Arora, who joins us today as the CFO. Anuj will be based at a corporate office in Delhi, reporting to me. He's a chartered accountant with over 23 years of diverse industry experience, spanning manufacturing, retail, and hospitality sectors. So, Anuj, welcome. Anuj is here on this call today. Welcome to you, Anuj, to Orient Bell.
Thank you so much, Aditya. This is my previous experience. I'll try and basically deploy all those process improvements and controls that I've done in my previous organization so that we do a sustained growth in OVL as well. Thank you so much.
Thank you, Anuj. Yeah, Pooja, we can take Q&A now.
Okay, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashwath from Arihant Capital. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. My first question is in terms of have you seen any improvement in terms of our volumes, and if we could also give us our utilization levels for this quarter, it would be really helpful. Following questions I would ask later on.
There's a lot of background noise. We are not able to hear you. A lot of background noise is there.
Ashwath, can you please use your handset?
Is it any better?
Yes, sir. Please go ahead.
Yes. My first question is on the utilization. Could we have what is our utilization for this levels for both our captive plant and the paying facility?
Ashwath, we can't hear you.
Yes, sir.
I'll join back the queue.
Yes, sir.
Yeah,
Thank
please.
you.
Yeah.
The next question is from the line of Keshav from HDFC Securities. Please go ahead.
Thank you for the opportunity. So wanted to get a sense on the demand. How has been the demand in July, and when you expect the demand to pick up? Like the real estate cycle has been strong, which we have been talking. So what is stopping the demand to pick up? And lastly, is it something like unorganized would be gaining market share? How are you reading the market situation?
Thanks, Keshav. So, Keshav, demand was, if you talk about export, I talked about a couple of things which are impacting us. One of them was export volume. So we saw actually that May 25 was better than May 24. That is the last month for which official data is available. Checks in Morbi tell us that June was also better. But from July onwards, again, there is some pessimism in the market because of this US tariff wars and uncertainty. Almost 7 to 8% of our tile exports, Indian tile exports, will land up in the US. So we don't see an immediate recovery in demand. One silver lining is that more and more units in Morbi are taking shutdown. So our data is that in the last 3 months, approximately 39 units have taken shutdown. So to some extent, the supply is self-correcting. Though there are some new units also which have come out, and that will also add to our capacity.
Okay. Got it. So, but what is the take on the domestic demand? Why is it not yet picking up if the real estate cycle was strong? So how should we read that? Is yet to play out, have play out? How should we read it? Or is it Morbi who is possibly pushing the volume?
So see, Molby is also struggling. So I think demand is not as strong as what we thought it would be. Since in quarter one across allied sectors, I think I saw some recovery in cement in quarter one. Good recovery, double-digit growth. So I think that augurs well for quarter two and quarter three for the tiles, because tiles basically comes in the later part of building and construction. Molby continues to dump stocks as they have been doing in the past. So overall demand in quarter one has been sluggish.
Okay, got it. Thank you. That's it.
Thank you, sir.
The last.
The next question is from the line of Primal D'Souza, an retail investor. Please go ahead.
Hello, good evening. Thanks for the opportunity. My question is, could you please evaluate on Orient Bell's entry into engineered stone segment? Also, do you have any plans to tap the high-value potential Gulf market in the future?
So two questions. One is about engineered stone. So
yes.
We don't have that product today. What we find is that bulk of engineered stone is going into export, that too into the US market and all, so not very sure that we would get into this category. However, we do sell an increasing amount of large slab, 6 feet by 4 feet, 2.5 feet by 8 feet, the volumes of which have been growing nicely. Your second question was about the UAE market and all. So we have historically not been into exports. Export is not a branded play at all. Exports from India are typically, price-led exports, not brand-led and all. And of late, over the last 2 years and all, if you are following this sector closely, you would see that a lot of Chinese ceramic players have opened units in the Gulf area, and which has further impacted the export potential to Gulf.
Okay, sir. Thank you.
Thank you.
Thank you, ma'am. Ladies and gentlemen, to ask a question, please press star and 1 now. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Ashwath from Arihant Capital. Please go ahead.
Yeah, hi sir. Am I audible now? Is it better?
Yes, sir.
Okay. So my question is on our margins. We have taken a slight hit on margins compared to the industry leader. So I wanted to understand the scenario on the relative basis as, I mean, are we taking a hit on our ASP or what is exactly happening?
So Ashwath,
Hello.
So Ashwath, what I understood from your question was that this question was on margin. You said that our margins have been sluggish. Is that what you are saying?
Yes.
So you are talking about EBITDA margins. So I think, Ashwath, this is basically where the scale comes into play. Basically, they have the market leader has had much better margins than us, and why only tiles? This is something which plays out in every industry. The market leader with the benefit of volume and synergies, of and economies of scale will have a better margin. Just like to point out to you that our gross margins historically have been amongst the best, or maybe the second best in the industry. What hurts us is that the operational leverage is not there, the scale of operations is not there. So if you see this year also our gross margins have improved. So that piece is not really a worry. The bigger piece for us is to get into aggressive volume growth.
Okay. So another question is on utilization levels. Could you quantify on?
Sorry to interrupt you, sir. Your voice is breaking.
Is it any better now?
I think working down and all. Maybe we can go to the next person.
Yes, sir.
Sure.
Ladies and gentlemen, to ask a question, please press star and 1 now. Participants who wish to ask questions may please press star and 1 at this time. The next question is from the line of Moksh from Arum Capital. Please go ahead.
Hello, sir. I wanted to ask, our marketing spends are currently at 3.7% for this quarter. So how are they for the next 9 months? Are we planning to increase the marketing spends to 5%, or we are trying to maintain it?
Can you repeat the question, please?
Yes. So our marketing spends are currently at 3.7%. So are we planning to increase our marketing spends at maybe 5% for the next 9 months, or the spends will continue?
So much, I wouldn't go by a percentage guidance. Percentage is totally dependent on the denominator. So what I would tell you is we have continued investing in branding. We had spoken about this, I think almost 1.5 to 2 years back, and we have been on TV, and we also been aggressive on digital and also very aggressive on all our tools. We have taken building OBL brand as a priority area for us, so we continue to do that. Whether it will be 3.7% or 4% or 3.5%, very difficult to say, but ballpark, to give you a sense, I think we will be in around this range, and we'll continue to invest in branding.
Okay, and around what amount are we planning to spend this year?
No, we don't have that guidance. A lot depends on how the market shapes up and how the demand shapes up.
Okay, and what are some levers for your margin improvements? Because I think we are increasing our marketing spends and demand is not that visible for us. So are margins going to stay at for at this capacity utilization at this sales route? Are margins going to stay where we are here, or is there some scope for margin improvement?
There is. So as capacity utilization increases, see, first quarter is always a historically weak quarter for the industry. So as capacity utilization increases, margins would definitely improve. With just one caveat that how gas prices behave is something nobody knows. But at constant gas prices, we will definitely see better margins with as capacity utilization improves.
Okay, and we saw some shutdowns. I think you mentioned 39 units closed in Morbi in quarter 1. So are we seeing other trend of shutdowns increasing? Like what do you see? What are you seeing the current industry scenario in Morbi?
So when I was there last month, generally the mood was pessimistic and not very positive. I heard for the first time in many years, talked about some Morbi units going into NPAs, which is something which one had never heard before. So overall, it's people are cautious. I have not heard, what those 20-30 odd units which are supposed to come up in H1. One has not heard of many new units being announced for H2 or for next financial year. So I think there is a cautious. There's caution in the air. People are like wanting to wait and watch how the market turns.
Okay, and so is the trend of smaller players shutting down and the larger players being gaining market share? Is this what the industry scenario like going on, or the bigger players also shutting down their capacities?
So you are talking specific to Morbi. So yes, the units which are shutting down are typically units which have got smaller capacities. The units with bigger capacities are still able to get some efficiencies and sell at lower prices. But smaller units are facing the brunt of the demand sluggishness.
Okay, and that is due to because demand slowed down domestically and also because of exports not being that export demand not being that great. So it's like a double whammy for the industry. Is it the scenario?
Absolutely. See, I just tell you, for the Ministry of Commerce data shows that in FY17 there were almost zero exports of tiles from India. And from FY17 to say about FY25, we are at about, last year we were at about 1500 crores of exports every month. So from 0 to 1500 crores a month in 7 years, a huge amount of capacity was added in Morbi. And now with last year exports were down. This year I would say Q1 exports would be flattish or slightly down. So all this capacity is now playing out into the domestic market and depressing demand.
Okay, and so the consolidation you expect would take a lot longer time because after 8 years we are seeing this kind of consolidation.
Yeah, see, so jury is still out on this, but the talk of NPAs with so many units going under NPA in Morbi, there are so far no takers for these units.
Okay.
So people are not going after adding too much capacity. As I said earlier, people are being cautious now.
Okay, that was quite helpful. That's all from my side. Thanks for all the explanations of the industry. Thank you.
Thank you, sir. The next question is from the line of Rohit from Samatva Investment. Please go ahead.
Good evening, sir. Thank you for the opportunity. So I just had one question. Recently, we got into a new segment in the tile adhesives segment. So just wanted to know our rationale behind getting into the segment and what kind of capex are we looking forward to in this segment going forward?
So Rohit, we are not looking at any capex immediately. We are getting this manufactured as per our specifications from partners. We will evaluate our capex on this as the business goes. Anyway, this is not a very capital intensive business. The rationale is that we have a large distribution network. And customers need tile adhesives and other bonding chemicals and all. And there was a lot of demand from dealers that get into this. And this is as more and more tiles are becoming vitrified, people are this is a growing market, and so it's a good time to get into it.
Fair enough, sir. Thank you so much and all the best.
Thank you, sir. The next question is from the line of Guneet Singh from Counter Cyclical PMS. Please go ahead.
Hi, sir. I would like to understand what's the current capacity utilization?
Yes. So quarter one, just give me a second. So I think capacity utilization would be about 60% in quarter one.
So, sir, by when can we expect to achieve optimal utilization levels? And like you mentioned, economies of scale, do we see any margin benefits when we reach the optimal utilization levels? And if so, can you quantify what the steady state EBITDA margins can be, even if we consider the current, scenario and the current gas pricing? So what kind of EBITDA margins can we expect at the optimal utilization levels?
So we don't give out forward estimates on EBITDAs or revenue, but considering that there is a lot of capacity which is available in our own units and our associate units, and also given the fact that we do not have any major capex which is planned in the future, margins would definitely improve with capacity utilization. Our costs are all fixed costs, and as I said, we have very healthy gross margin. So EBITDA would only go up.
All right. So, it's fair to assume that we have a revenue potential of 1,000 crores. So, what are the main constraints that you're seeing currently? Because we are seeing news that the real estate has been doing well. And so, what are the main constraints for ramping up, and by when do you expect to ramp up to optimal utilization levels?
See, you say real estate is doing well, but at the same time, we have most of the building and construction industries not doing too well over the last 1.5 years. So that itself is a quandary. It somehow doesn't make sense, and I think tiles is suffering from the same problem. The biggest problem, I think, we have talked about the demand scenario, and also I don't want to repeat that. From an Orient Bell perspective, I think our problem has been that we were historically very heavily dependent on ceramics. There was a time when in the recent past, that 65%, 70% of our volumes were coming in from ceramics. And while we have been gaining on vitrified and GVT for the last 1.5 years, but the loss on the ceramic tiles has kind of eaten away into the benefit that we have had of this GVT growth. Now, the way things are, our ceramic and GVT ratios are kind of similar with the industry peers. So that negative drag on our volumes is now much lesser than what it was, say, last year or the year before. And we have also added capacity for GVT, where we have significant, upsides on capacity utilization. You said 1,000 crores. I think I would put it at closer to 1,200 crores of revenue capacity is available to us today, if I also take into account our associated entities.
All right, sir, got it. So, so if we just compare year on year, so you are saying that the conditions look a bit better as compared to last year. Also, in your experience of being in the industry for the past many decades, can you say that this is cyclically amongst the the slowest periods that you've witnessed? Or, where would you place the current demand scenario and the current, margin scenario when it comes to your industry?
Yeah, I would agree with that. I think it is a very slow time, much slower than what it has been in the last 7-8 years that I've been seeing this industry. But we all know that real estate has always been a cyclical industry, and we have been facing subdued demand and all for the last few years. The good thing is that new capacity addition in Morbi is something which is really slowing down. So it's only a matter of time where these increasing shutdowns of Morbi units, the older units, and not too much of new capacity coming in is going to turn the tide in our favor.
All right, sir. Got it. Thank you very much. Join the queue.
Thank you, sir.
Thank you.
The next question is from the line of Rohan from RAS Capital. Please go ahead.
Sir, good evening. My question is regarding, have there been price cuts in this quarter due to the environment that we are operating compared to last quarter? And if yes, then we have still seen an increase in the gross margin. So what would be the reason for that?
So yes, Rohan, there have been price cuts. As I mentioned in the opening statement, our average selling price is lower than what it was. And bulk of that is because of more aggressive discounting. To your second question, why our gross margins are better? I think our gross margins are better because of very frugal manufacturing and other cost basis. We have spent on marketing, yes. We continue doing that. We had TV campaigns on in the first quarter of this year. But our wastage and our control on manufacturing costs has been very, very tight, which has helped us give better gross margin.
Right. Okay. And going forward, would you say that operating margin will kick in? Because you said capex also is very low. So if the demand is to pick up in the next quarter or so, what are your thoughts on that?
Absolutely, because as I said, capex, there is no big capex which is coming forward, which is going to happen this year. We have available capacity, and as demand picks up, given our gross margins, such a gross margin, it will directly flow into EBITDA.
Right. Okay. Sir, and just one more question. Without going into the financial or the numbers, just based on your experience and the information you have, what is your analysis of the next few quarters to come from an industry point of view, and second, also how it's going to impact Orient and the position we are in? You obviously said what's happened so far in Morbi and with Orient, but I just wanted to get an understanding of the industry and Orient as a whole in the next quarter or so. Because I was expecting it would only get better from here, but just wanted to understand from you.
So, in today's world, to try to predict something one doesn't is a very, very dangerous business. One tweet changes everything. I sense, what I sense is that there are some positives which are being seen. I talked about it. I talked about capacity addition at Morbi, or even the established players and all. I think capacity addition has slowed down dramatically. That's mid-term positive for the industry. Indian tiles are technically as good as any other country, and at a fraction of cost of what other countries charge. So I think once this tariff thing kind of gets settled down, it will restart the flow of tiles. I had mentioned earlier that May 25 was better than May 24 as per the official data, and sentiment is that June was also better than June 24. So I think a lot of stuff is happening which is a structural positive for the industry. And at Orient Bell, because a couple of things that we have been doing, we are very tightly focused on end consumer experience. We have a very tight leash on our costs historically. And we are making investments on brand and distribution. So I think we are well positioned to kind of grow our margins and grow our revenues once the market turns for the positive.
Okay, sir. And also welcome to the new CFO. So is he on the call today?
He is on the call, but he's not going to take any questions. He just joined us 3 hours back. So yeah, but he's there.
Okay. Yeah, okay. My only question was going to be what is maybe the top 2 things that's the top priority at the moment for the CFO to come and take charge of. What is your view of that you would like him to take over the top couple priorities?
So I haven't had that discussion with him yet. So I think it's extremely unfair to kind of have this discussion on this call. But I think next quarter, Anuj will definitely answer this question for you.
Sure, sir. Thank you so much.
Thank you, sir. The next question is from the line of Ashwath from Arihant Capital. Please go ahead.
Ashwath, maybe your line was very bad. Maybe you can just ask one question at a time and I'll try to answer it.
Yes, are you audible? Can you hear me now?
Yes, I can.
Okay, so I'll just go one by one. Number one is in terms of what is our strategy for tier 2 and tier 3 markets, since we have decent capacity in ceramics, and as far as some channel checks are concerned, we have had talks of ceramic being still in demand there in tier 2 and tier 3 markets. So is that true, one, and what is our strategy going forward?
So Ashwath, what we are on to ask for strategy specifically on ceramics. So what we have done is this year is we have decided on a few sizes on ceramics which we are much more aggressive on. We are aggressive on these sizes in terms of new product development. We are aggressive in terms of filling up distribution gaps. We are aggressive on pricing on this. So that has, so our ceramic volumes have done better than what we expected in Q1. So this strategy seems to be working for us. And you are right, this is more of a tier 2 play, and not just tier 2. I think tier 2 and tier 3 play. And we are expanding our distribution. We are expanding our display footprints in these areas.
Yeah, my second question is on the dealer inventory right now, and what is your outlook on what is happening right now? Any update?
So Ashwin, I think you had asked this last time also. The dealer inventory is, my sense is lower than what used to be. 2 things are playing on dealers' minds. One is that there has been steady erosion in the selling price by tile manufacturers. So they don't want to keep inventory. That's it. Second thing is they're also seeing a very rapid change in preferences. Now there are so many tiles, so many sizes which are available that the dealer is finding it very difficult to predict which one will sell and all. So the way he is safeguarding himself is like trying to reduce his inventory. You have full body tiles, we are selling full body tiles in 3 different thicknesses, for example, the same size. And so is everybody else in the industry. So very difficult for the dealer to kind of think what will sell and what will not sell. So they are just squeezing down on inventory. Or worse still for us, buy stocks and then not pay the manufacturer till they have sold it out.
Okay, sir. And any quantification on the ASP or if not a number, has it been stable? Has it grown? Has it degrown over the quarter? Or and what is our outlook on this going forward?
So ASP has gone down, Shwat. See, as I said, we have had flattish volumes. so that 3% revenue drop which you see is largely coming out of almost everything is coming out of ASP. And ASP has gone down because we have been kind of matching the market on discounts.
Okay, so got it. And we have done decent spends in the southern market, if I'm not wrong, on our marketing front. So have you seen any traction in volumes in that market?
So we are seeing some traction. Some slow traction is there. But it is taking time because South is one market where the downstocking of dealers is more visible. But we are seeing traction.
Okay. And so going forward on our marketing spends, would it be on similar lines or what would our strategy be?
So we did 0.7% of revenue. So I think we are committed to kind of spending in that range. Difficult to give out a forward-looking statement because I don't know what the denominator will turn out to be. But we are totally committed to investing in building up a brand over here. Through TV, through digital and through digital media and through our digital tools.
Okay, got it. And sir, in terms of now, given this overcapacity, assuming that this does not go down as soon, how do we see to tackle this problem altogether? Do we continue with the ASP front or do we ramp up our volume? So what would be our outlook ahead now?
See, so Ashwat, there is an industry level issue on capacity. There is not much which OBL can do about it. Our internal strategy is to ramp up our volumes. We are differentiating our products. We are strengthening our brand. We are strengthening our distribution network. We are also strengthening our product play. I mentioned some time back how over the last few years we have kind of moved from a 35% vitrified this thing to almost 55-60% of vitrified salience. So all of this is happening. Our products are much more current than what they used to be. Our marketing is more visible. Our investments on displays are bigger and better. So all of these things are just to drive those volumes. Ultimately, we have to gain market share from competitors.
Okay, sir. Yeah. Thank you, sir. I mean, that's from mine.
Thank you, sir. As there are no further questions from the participants, I now hand the conference over to Mr. Aditya Gupta, sir, for closing comments.
Thank you, everybody. Thank you for being part of the call, and look forward to hearing from you all in the next quarter. Thank you.
Thank you, sir. On behalf of Orient Bell Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming con calls.